Welcome to the Deep Dive. Today we're jumping right into something really fundamental if you're thinking about starting a business in Singapore.
Which is?
Choosing the right business structure. Honestly, it can feel a bit like staring at a complex map with all the different legal bits and compliance stuff.
Oh, absolutely. It can seem overwhelming at first glance.
But that's why we're here, right? To sort of guide you through it.
Exactly. The goal for this deep dive is really to cut through that complexity, give you some proper clarity. We've been looking at, the official stuff from the Singapore government.
Like ACRA, IRS.
Right. Go Business Singapore, IRS, ACRA. And also insights from people who do this day in, day out incorporation specialists. We looked at JWC, Rickvin, Pte Ltd Asia, OSOM, plus various guides.
So a good mix of official sources and practical advice. Consider this your fast track to understanding the basics. Our mission today, we want you to walk away from this feeling like you really get these structures, understand the pros, the cons.
So you can make a smart choice, one that fits your goals, how much risk you're okay with, and, well, your big picture plan.
Okay, let's get into it. What are the main options someone starting out in Singapore really needs to wrap their head around?
Okay, so broadly speaking, you've got a few common structures. First up, the sole proprietorship.
The simplest one.
Yeah, pretty much. Run by one person. The key thing here, and it's a big one, is that the law sees the owner and the business as, well, the same thing.
So no separation, meaning if the business owes money or gets sued.
You, the owner, are personally on the hook.
Yeah.
Your own assets, like your house or savings, could be at risk.
Oof. And things like passing the business on.
Very limited flexibility there. It's tied to you. Tax-wise, it's your personal income tax rate. The progressive system, earn more, higher tax rate potentially.
Right.
The upside, compliance is simpler, just an annual renewal, basically. But getting bank loans, that can be tougher.
But setting it up is easy.
Generally, yes.
Yeah.
Quick and straightforward.
Got it. Simple start, big personal risk. What's next?
Then you have partnerships. A general partnership, specifically. This is for 2 or more people, up to 20 partners.
Okay.
And like the sole proprietorship, the partners are personally liable for all the business debts and legal stuff.
Wait, even for things another partner did?
Yes. That's the catch. You're jointly responsible.
That sounds like it needs a lot of trust.
Definitely. And succession depends heavily on your partnership agreement. If one partner leaves, the whole thing might dissolve. Taxes are still at the individual partner level.
And compliance funding, similar to the sole prop.
Pretty similar, yeah. Fewer compliance hoops, annual renewal, but funding can still be tricky. Setup is relatively easy, usually just needs that agreement.
Shared rewards, shared risks, very shared risks, it seems. Are there other partnership types?
There are. You've got the limited partnership, or LP. This one's a bit different. It needs at least one general partner.
The one managing things.
Right. And they have unlimited liability, just like in a general partnership.
Yeah.
But then you also have one or more limited partners.
And they're limited how?
Their liability is capped, usually at whatever amount they invested. And crucially, they generally can't be involved in managing the business day to day.
Okay. So that structure might work for bringing in investors who want less risk and no management hassle.
Exactly that. But remember, that general partner still carries all the personal risk. Succession is still quite rigid. Taxes are individual rates.
Besides.
Funding, still relatively simple compliance, annual renewal. Funding. Banks tend to steer clear of LPs for loans. Setup needs that formal agreement setting out who's who.
Okay. Then there's another one, the LLP, Limited Liability Partnership. The name sounds promising.
It does offer more protection, yes. An LLP involves 2 or more partners, but, and this is key, it's a separate legal entity from the partners.
Separate legal entity, like a company.
Kind of, yes. It means partners generally aren't personally liable for debts arising from the wrongful actions or negligence of other partners or employees. Your liability is more focused on your own actions.
So a definite step up in protection compared to a general partnership.
For sure. Succession is usually more flexible, too. Taxes, though, still flow through to the partner's individual income.
What about compliance for an LLP?
A bit more involved. You need to submit an annual declaration of solvency, basically confirming the LLP can pay its debts. This is typically done by a designated manager.
And funding, setup.
Banks might still scrutinize LLPs more closely than companies, perhaps. And setting it up requires formal incorporation with ACRA.
Right. Okay, so we've covered the ones where tax generally hits the individuals. Now the big one, the private limited company, Pte Ltd. You hear this one mentioned a lot.
It's easily the most common structure, and for very good reasons. A Pte Ltd is its own legal person, totally separate from its owners, shareholders.
Right, meaning?
Meaning it can own property in its own name, it can sign contracts, it can sue people, and it can be sued. It has perpetual succession. It keeps existing even if owners change. And the huge advantage, limited liability.
Ah, the main event. Shareholders' personal assets are safe if the company gets into trouble.
Precisely. Your personal finances are shielded from business debts and lawsuits against the company. That's a massive draw.
Absolutely huge. What about the tax situation? You mentioned the others are taxed individually.
Right. People LTDs are different. They pay corporate income tax. In Singapore, that's currently a flat rate of 17%.
Flat rate. Interesting.
But here's something really important. Only companies can tap into many of the government's tax incentives.
Oh, like what?
Well, for new qualifying startups, there are schemes like the Startup Tax Exemption CT and Partial Tax Exemption. These can exempt a big chunk of your profits from tax for the first 3 years.
Wow, okay. That could make a significant difference to the bottom line early on.
It really can. It's a major reason why many businesses choose the Part in LTD structure, especially if they anticipate being profitable relatively quickly.
Makes sense. But I'm guessing there's a trade-off. More benefits usually mean more admin.
You guessed it. Compliance for a Part LTV is definitely more rigorous. There are more hoops to jump through.
Such as?
Okay, you must appoint a company secretary within 6 months of incorporating. You might need an auditor, depending on your revenue and size. You have annual filing requirements with ACRA submitting financial statements, which might need to be audited.
Right, more formal record keeping.
Yes, and things like displaying your company registration number, the UEN, on all your business letters, invoices, website. That's mandatory.
And funding. Is it easier for a Pte Ltd?
Generally, yes. It's much easier to raise capital because you can issue shares to investors. Banks also tend to look more favorably on companies for loans compared to, say, sole props or partnerships.
But the setup itself is more complex.
It is. You need to register properly with ACRA. You need a formal company constitution. You must have at least one director who's ordinarily resident in Singapore and at least one shareholder. So more upfront work.
Okay, so it boils down to more protection, potential tax savings, better funding prospects, but in exchange for more setup hassle and ongoing compliance work.
That's a good summary, yes.
So when someone's standing at this crossroads, trying to decide, what are the absolute key things they need to weigh up?
Yeah, this is crunch time. Number one, absolutely. Personal liability. How much risk are you personally willing to take on? Can you stomach the idea of your personal assets being exposed?
That seems like the biggest differentiator for many.
It often is. Second, taxes. Really understand the difference between those progressive individual rates and the flat corporate rate. And crucially, investigate those potential tax incentives for companies. Could they apply to you? How much could they save you?
Funding has got to be high on that list too.
Right, definitely. What do you need now and what might you need down the line? If you plan to seek venture capital or large bank loans, a company structure is often almost non-negotiable.
Makes sense. And the compliance burden.
Yep. Be honest with yourself. Are you, or do you have the resources to be, prepared for the more demanding regulatory upkeep of a company? It means deadlines, filings, potentially audits.
What about succession planning?
Good point. Even if it feels miles away, think about the long game. Do you want to easily transfer ownership? Sell shares. Bring in new partners or owners smoothly. The company offers much more flexibility there.
Does the type of business matter?
It can, yes. Some industries might have specific requirements or just norms where a company structure is expected or even mandated. Think about the number of owners, too. Sole prop is just for one.
Right.
Consider the capital needed, too. Setting up and running a company usually costs more initially and ongoing than a sole prop or a partnership. And finally, just the sheer ease or difficulty of setting up and managing day-to-day. Simpler structures are, well, simpler to run administratively.
That's a really helpful checklist of considerations. Now, you mentioned incorporation specialists like JWC Accounts and HR. How can a firm like that actually help someone navigate this decision and the whole setup process? Their website mentions quite a few services.
Well, this is where they add real value, I think. They take that complexity we talked about and help simplify it. For incorporation, they don't just file papers, they should actually advise you.
Based on your specific plans.
Exactly. They'll listen to your goals, your industry, your funding needs, all those factors we just discussed, and help you decide which structure, Pte Ltd, LLP, etc., makes the most sense for you. Then they handle the actual legwork.
Preparing all the documents, submitting to ACRA.
Right, for whichever structure you choose. That alone saves a ton of time and helps avoid mistakes, especially with the Pte Ltd requirements, which are more detailed.
That sounds like a huge relief, particularly if you're new to Singapore's regulations.
It really is. And another practical thing, many new businesses, especially if run from overseas initially, might not have a physical Singapore address right away. JWC offers registered office address services, which fulfills that legal requirement.
Okay, so they get you incorporated correctly. What happens after that? You mentioned the company secretary role for Pte Ltds.
Yes, and that's mandatory within 6 months for companies. JWC provides company secretarial services. Essentially, they act as your appointed secretary.
Doing what exactly?
Managing the company's official records, making sure your annual returns and other required filings with ACRA are done correctly and on time, advising the directors on compliance matters. Basically, ensuring you stay compliant with the Companies Act. It's an ongoing role they manage.
So they handle that specific compliance piece. What about the financial side? Ongoing accounting and tax.
That's another core area for them. They can help set up your accounting system from day one. Getting that right is so important for tracking performance, making good decisions, managing cash flow, preventing problems later on.
And taxes. Corporate tax sounds like something you want to get right.
Absolutely. They handle the corporate tax filings with IRAS. That includes the estimated chargeable income, ECI reporting, and the main annual tax return, Form C. And if your business grows and hits the SGD 1 million revenue threshold for GST,
Goods and services tax.
right, they can manage the GST registration and the ongoing filing of GST returns too.
So they're covering a lot of the mandatory financial compliance.
They are. Plus, preparing the actual financial statements and the director's report that companies need to file annually. On the people side, if you have foreign directors or need to hire staff from overseas, navigating work pass rules can be tricky.
Employment pass applications and things like that.
Exactly. JWC assists with those applications, which depend on salary, qualifications, the company's standing, etc. They also offer payroll services, calculating salaries, handling CPF deductions for local staff, making sure you're following employment law.
It sounds like quite a comprehensive package, really. From idea to incorporation to keeping things running smoothly compliance-wise.
That seems to be the goal, yes, to provide that ongoing support so the business owners can focus more on, actually running the business rather than getting bogged down in admin and regulatory tasks. They also mentioned having a network of partners for other needs, too.
Like legal or marketing, maybe?
Potentially, depending on the need. And importantly, they emphasize starting with a consultation call to really understand your specific situation before recommending services.
So whether it's the apparent simplicity of a sole proprietorship or the structured protection of a Pte Ltd, really understanding what each choice means well, it's vital.
It absolutely is. And knowing there's support available, like from JWC, to handle the complexities can make the whole process feel much more manageable.
It really frames that initial structure choice not just as paperwork, but as a strategic decision, doesn't it?
Totally. It affects your risk, your taxes, your ability to grow, how you bring in money. It's foundational. You really need to think it through properly.
Okay, so let's quickly recap. We've walked through the main business structures in Singapore: sole proprietorship, partnerships, general, LP, LLP, and the very common private limited company.
Highlighting the key differences in liability, that's a big one, but also taxation, how easy it is to get funding, and the level of compliance involved. Each has its place.
And we've seen how specialists, using JWC Accounts and HR as an example, can step in not just to process forms, but to provide advice, handle the setup, and manage ongoing compliance, like company secretarial, accounting, tax, and even HR tasks.
Letting entrepreneurs focus on growth, essentially. The main thing for you listening is that this choice matters a lot. It impacts your business journey right from the start and long into the future. Don't rush it.
Definitely food for thought. And maybe here's a final question to chew on. Beyond the immediate pros and cons, how might your chosen business structure affect your ability to pivot, adapt, or seize unexpected opportunities years down the line? What's the most critical question you need to answer now as you move forward? Thanks for joining us for this deep dive.